Hey everybody, Boris Hausberg. Welcome to our chapter on how to protect yourself from crypto theft. And as always, trading foreign exchange on margin carries a high level of risk that may be suitable for investors. I ask you to disclaim very carefully to send all the risks associated with trading on margin and seek advice from an independent financial advisor if you have any doubts. So the big question is, how much Bitcoin has been stolen since it's been in its existence? And I think you would be shocked, absolutely shocked to find out that almost $500 million worth of Bitcoin, $500 million worth of Bitcoin has been stolen since 2010. And what I mean by stolen is that literally it has been taken away and never recovered. The thing that makes Bitcoin so engaging and so enticing to so many people, the anonymity, is exactly the thing that makes it so vulnerable to theft. It is exactly like cash. Imagine you're carrying a bag of $1 million of cash in your backpack, and the bills are unmarked. It's even actually worse because you may have bills that are marked in cash, and you could possibly trace those bills. But these bills are unmarked. They don't have any identifying numbers on them that you could then trace. And you drop that $1 million worth of cash at an airport, you step away, and boom, your knapsack is gone. And then the person who has that knapsack has all your money, and you never, ever have the ability to recover it. So that's the sort of big tragedy of Bitcoin as far as an investment asset. It is very vulnerable to this particular form of theft, which is almost bulletproof, foolproof. This is why thieves and criminals absolutely love the idea of stealing Bitcoin. So since 2010, 7% of all Bitcoins outstanding have been pilfered away through a variety of various means. We'll talk a little bit about. They've been stolen in a variety of ways. But the one outstanding, sort of the grand big theft of all, was this exchange in Japan called Mt. Gox that saw 850,000 Bitcoins stolen from it. Everybody who had their money on the exchange, and this is a critical thing. If you're going to trade Bitcoin, you have to do it on some sort of a exchange basis. And once you deposit, the exchange holds your Bitcoins on that exchange, you're essentially leaving your money with them. And if they are somehow penetrated and the Bitcoins are stolen, your money is gone. There is no recovery. This is one of the critical, vulnerable points of trading Bitcoin on exchanges. Ethereum, which is another cryptocurrency, the number 2, I guess, cryptocurrency in the world, saw 225 million of the currency stolen. Bitfinex, another exchange, this one in Hong Kong, saw $72 million of currency stolen. So you see the pattern. There are basically several common ways of how money is stolen from Bitcoin. A couple of them are just sort of minor ways, but we'll address them all. So one way is just simply ransomware, where hackers just take down your computer, lock it down, and hold you ransom for Bitcoin because they know that if you pay them in Bitcoin, you can never trace the money back. So that's a sort of a minor, small thing. And of course, the recipe for that or the remedy for that is to simply keep as much of your data in the cloud as possible so it's backed up and you don't have to really ever be worried about what's on your computer. Another common way is to actually create a fake wallet. What people do with Bitcoin is, of course, they store their money in these digital wallets, and people now create these kind of fake digital wallets and get you to deposit money into those wallets instead of legitimate ones, and that's how they can steal the money away. A very, very common way, and this is one that sort of makes many people vulnerable. If you're an investor and want to hold Bitcoin, your password is very vulnerable to all sorts of phishing, and they are incredibly adroit at finding out what your password is for Bitcoin by sending all sorts of seemingly official messages to you of trying to extract the passwords. Another way is just to simply create fake cryptocurrencies. It's not simply just that you have Bitcoin, you have Ethereum, you have now almost 1,000 cryptocurrencies, and some of them are just literally fake. They just don't have any legitimate characteristics of what a cryptocurrency is, which means that they don't have any constraint on their volume. They don't have any even imaginary limitation to their essence. And OneCoin was one of those cryptocurrencies that just swept as a fake currency. There are also fake Bitcoin mining scams where they get you to mine, promising you lots and lots of big payouts, when in fact mining is an extremely expensive, capital-intensive business. It doesn't really pay off nearly as much as it used to. Another common way that people steal money is through P2P, person-to-person crypto exchanges, where if you, let's say, you don't necessarily want to trade on an exchange against a centralized party, you want to trade your Bitcoins person to person because you want to save on the bid-ask spread or save on the commission, or do direct transactions. Those transactions can also be fraught with risk. So quite a lot of various ways to steal your money or to steal your Bitcoins from you, which in fact is, of course, an asset. But if you're a trader, the most vulnerable places for crypto traders is the Bitcoin exchanges themselves. You really have to have faith that the Bitcoin exchange you're trading on is going to be there, is not going to be penetrated. Because remember, the money that you're trading, you can't trade unless your money is deposited on that exchange. That exchange holds your capital in the form of Bitcoin. It takes your dollars, converts it to Bitcoin, holds it in a digital vault on the exchange. And if somebody comes into the exchange, it just simply extracts your Bitcoins from them. You are therefore just out of luck. You simply have lost all your money. Imagine if you just wake up one morning and somebody raided Charles Schwab and took away all of your stock certificates, and there was no way to trace the provenance of those stock certificates to you. That there was no other central database that could verify that yes, you indeed had those stock certificates. Bitcoin wallets, of course, is another way that people have their money stolen, because sometimes people will say, well, I'll keep my money in a Bitcoin wallet and I'll just drop a little bit of Bitcoin into the exchange and I'll keep the rest of it sort of separate from the exchange. But then the wallet itself could get hacked. And finally, we talked about the fake crypto exchanges, the fake P2P crypto exchanges, where somebody basically poses the fact that they have Bitcoins, but in fact do not. Now, how do you protect yourself against this kind of theft? So there is a very interesting Reddit thread, and I just took this out. I just wanted to show you sort of the absurdity, the length, the extent that some of the Reddit commenters have shown that you need to go to in order to really feel secure about Bitcoin thread. And I'll just read this out loud. Not that I'm recommending this, but I thought it was interesting because it sort of speaks to the essence of the vulnerability of the trade. You buy an old computer with no sound cord, no network, no Wi-Fi, no Bluetooth, no hard drive. So that means completely off network. Boot from a Linux live CD, write your own key generator from scratch, enter several thousand random numbers generated from true random source, such as radioactive decay Geiger counter. Write down the private key by hand on acid-free archival paper and no fade ink pen. Make sure your windows are closed and no cameras or spy equipment are nearby. Destroy the computer and monitor immediately afterwards using high-temperature furnace. Cover the private key with plastic and a thin sheet of metal so it can't be read using exotic methods. Do all of this in a Faraday-shielded room. Now you can send coins to your new address with a fair shot at not getting stolen. So this is all really about protecting the password, because remember, every Bitcoin needs to be opened up with a password. And it's this password that once it gets stolen can open up all of your Bitcoins and have them taken away from you. So as absurd as this particular advice sounds, quite a lot of people actually do this, which is the very old technology method of writing down your password on a piece of paper and then storing it, sometimes even in an old-fashioned bank vault. So you have this digital asset that is actually protected by these very old 19th, 18th century methods of bank vault. And I think that speaks quite a lot to the risk of Bitcoin as an asset. If you're sort of an investor who wants to hold this as an asset, this is the primary risk you have. Now, of course, these are all things you can do to protect yourself. And frankly, things are getting much better as far as security. But security is never absolute. And because it's a distributed system, it's always very vulnerable to all sorts of hacks. And precisely because it is anonymous, it is non-recoverable. I think this is the critical thing about Bitcoin that you need to be aware. It is not an asset you can ever recover once it's stolen. So the risk of loss is pretty much absolute. And that is a key thing to understand as an investment asset. But on the other hand, you can trade Bitcoin. And you can trade Bitcoin essentially on a virtual basis. Now, there's 100 different ways you can trade it on a real basis as well, but on a virtual basis, what I mean by that is you can trade it with a CFD broker. Here's a Bitcoin broker with giving you full bid ask. Now, remember, in this particular case, what are you doing actually? You're not holding any real Bitcoins when you're buying or selling this. You're just holding a virtual demand on this particular asset, just like when you don't hold euros or dollars. When you're buying euros or dollars from a CFD broker, you're just holding the virtual liability or the virtual asset when you're making a transaction. Same kind of a thing. You're just making a general ledger transaction. And although that may seem less pure, in many ways, it's actually quite a lot more protective. Your money sits at a CFD broker, which sits in dollars, which are protected, which are traceable, which are recoverable under a lot of different scenarios that are not anonymous. And your risk now becomes just simply market risk instead of asset risk. And I think that's the critical thing. If you're an investor and you hold physical Bitcoin, you have asset risk. If you're a trader, you really only have market risk, especially if you're trading this with a legitimate, well-capitalized CFD firm. Now, you can buy cryptocurrencies, as we've talked about, from a variety of platforms. You can buy them as CFDs. You can buy them in Bitcoin wallets. You can even buy them as effectively stock certificates on NASDAQ at GBTC. Again, all of those things, I think, in some ways are good abstractions, right? They're good abstractions because you don't actually hold not all of them. If you hold a Bitcoin wallet, you certainly hold the actual currency. I think the point I'm trying to make is that if you are essentially in the crypto game trade, it's much better to abstract yourself. And the irony of the whole thing is, while everybody's saying you have to have Bitcoin, you have to have the real thing, the danger of having the Bitcoin, in my opinion, far exceeds the value of it, because if you're trading it, you can ride the valuation. Bitcoin is going to rise relative to dollars. So if you buy it at 5,000 and ultimately Bitcoin goes to 20,000, you still have made money in capital assets by having a large gain. And ultimately, all exchange rates have to be converted one into the other. So trading it virtually gives you the exact same market benefit without exposing you to the capital risk that it is. So my recommendation is if you want to trade Bitcoin and you're outside of the U.S. where you cannot do CFDs, if you're in a CFD allowed jurisdiction, you can trade with these very good brokers. And these brokers allow you to trade Bitcoin all the time. Notice, by the way, one interesting thing sort of when you go back to Bitcoin trading, this is not a cheap asset. The spreads are pretty wide. This is a 15 spread here, and the spread can get 100. Sometimes it can even get 200. And it's in a fast market, it could crash very quickly. So from a trading point of view, you have to be aware this is a highly volatile, widespread, really difficult asset to trade sometimes. But on the other hand, trading it virtually protects you from all of these terrible things that we talked about that really expose you if you own the asset outright. So bottom line is, if you want, like the majority I think of people want, to just simply participate in the Bitcoin rise without actually exposing yourself to all the vulnerabilities of owning the Bitcoin asset, it's much better to trade it with a CFD broker on a virtual basis.